Part three, ladies and gentlemen, we're going to talk about the oil market. What does the oil market, supply, stock, inventory, prices tell us about this economic recovery? It's a very important commodity that tells us what economic actors are willing to invest in to build for real economic activity for the future. What are they seeing? What are they thinking? We're going to ask Jeff Snider, head of global research at Alhambra Partners. Jeff, article, blog post, Alhambra Partners, people know the drill. It was on February 24th, and it was called Hot Oil, Cold Weather, Uncle Sam's Green. And you start out talking about the U.S. Energy Information Administration and the total amount of gasoline supplied by the domestic marketplace reaching 8.4 million barrels per day in the second week of February, so 2-3 weeks ago. And is that a good number? I don't know. I'm not in the business. Is that a good number?
It's one of those things. It's not a good number, but it's better than it had been. And at least it's moving in the right direction. In product supply, what the Energy and Information Administration is trying to tell you is that's how much product that the system has supplied into the marketplace. So it's sort of a proxy for demand. And so what we want to see is that, especially gasoline demand has been severely depressed for many, many months. It had fallen off sharply like anything else in March and April when everything was closed, the major shutdowns. It had come back sharply in May and June, but then like the labor market, it kind of stopped. And it stopped significantly below where it should be. And should be if there had been no interruption in any kind of any parts of the economy. So gasoline demand came back, but like the labor market, it never really came back.
What about just last week? So you wrote this on the 24th, but the week before, or at least the most recently weekly number when you wrote it, was really affected by the shock, the polar shock that ripped across the United States. And so we saw a drop both in demand and supply. And so what does your analysis lead to from there? Can we look at this particular week?
Well, I think it's probably one of those weeks that you throw out and say, okay, that's an anomalous week, that there was weather factors, in this case, actually serious weather factors involved. So it may not be that we look at that. As far as demand overall, especially in gasoline, that had been trending in the right direction going back to early January, which, as I think everybody knows, that's when the second of the stimulus payments came out, the $600. So there is some kind of detectable influence, at least in terms of gasoline, with Uncle Sam's generosity. We saw that before. I mean, you can make the case that a lot of the gasoline purchasing up into, in the early parts of the recovery last year were due to the initial helicopter payments from Uncle Sam. And so, maybe these latest ones from starting from the end of last year has had an impact, at least in some of these, some of the economic factors, including the use of gasoline.
What about stocks, Jeff? I'm going to pull up oil stocks and gasoline stocks, and it seems like they're high, but within the recent range of experience of years. But of course, there's a twist regarding production. Let me
as you're showing here, the oil prices have been on fire. I mean, oil has basically gone vertical here, which again, that feeds into the inflation hysteria that's ongoing in a lot of other places. The idea that this is the start of some kind of either commodity super cycle, or if it's based on the Federal Reserve excessive money printing, as we keep getting told, that this is the end of the road for the U.S. dollar.
Well, then if prices are surging, then I would think producers are producing like crazy.
Yeah,
let's get that out there. No,
right? Which is basic economics, right? That's economics 101. If we have prices fall, then supply should be matching with prices, or prices rising, then supply should be rising to meet it. And we've seen the exact opposite of that. So we had so much production shut down last year, an enormous amount of production, in fact. And it's never really come back. Now, the low of the latest week was due to a lot of the Texas portions of the production system going offline. But still, even before the week before, February 12th, it was still about 20% less than the peak in 2020. So the reason oil prices are coming back is because producers have been very reluctant to restart their supply. And so we have essentially a supply squeeze going on.
You know, for our audience that's just listening via podcast, they don't see the graph we're looking at. The last time I saw this sort of profile was when I was in Yosemite, and I was looking at Half Dome. So you see the mountain rising and then sheer cliff face. And then now there's no recovery despite the surge in price. So we're still on the floor of the Valley of Yosemite. Beautiful place, by the way. Jeff, have you ever been there?
I have not been to Yosemite.
I think it's one of the most beautiful places on earth. I haven't been everywhere, but it's amazing. Okay, so stocks are high, but not unusually high relative to recent experience. But wait a minute. Production has been cut drastically, so the stocks, both in crude oil and gasoline, should be plunging. They're not.
Yeah, that's what I think that's why producers have been reluctant to restart production, is because oil inventories are not falling as quickly as maybe I hate to use the word should, but maybe not as quickly as they might have if things were really improving as much as we thought. Now, again, I should point out, this is a period, early part of the year is a period of seasonal accumulation. So the fact that inventories are even falling at all is a win for the oil market. And it's one of the things that is buoying the oil price, because they're saying, look, at least inventories are being draining when they should be building under a normal typical year. So the oil market is saying, okay, things are improving, maybe not as quickly as we want, but at least they're moving in the right direction. Even gasoline, which is a little bit more on the concerning side. Again, as we talked about before, gasoline demand remains completely off the charts low. So even the fact that gasoline being used is down, inventories remain high, at least in this part of the energy system. So there's still, you can understand why producers have been reluctant to restart a lot of production, because the fundamental balance of the market is really precarious, and it's really based on the fact that supply has been so careful about getting back online.
And right now I just pulled up a chart, which we've been talking about, and now you're comparing the most, since 2016, product supply, finished gasoline. And here we can see just the completely detached. Just how
depressed. I mean, I don't think this chart really does it justice. We're talking about a 15 to 17% shortfall in gasoline used across the entire economy. I mean, 15% less use of gasoline. And we're talking not just, last year during the pandemic's early stages, but throughout most of the rest of the year and to start this year. I mean, that's an enormous shortfall in this crucial commodity. And so, back to our original thesis, again, what's going on in the oil market with contango being purged out of the futures curve, the curve going back into backwardation. What the oil market is saying is that we're seeing enough improvement in the fundamental propositions here that we're going to project into the near term and maybe into the intermediate term that it's going to continue getting better. And maybe that, furthermore, the stimulus payments, quote unquote stimulus payments or stipends, including not just the one in December, but the one that's going to show up eventually, the next one, these things will get us through so that, maybe by some point in the not too distant future, things might be at least closer to normal again. The economy could be back in relatively decent shape. We don't know what that actually means, especially if you're an oil producer. But at the very least, it looks like things are moving in the right direction and might stay in the right direction for a little while.
So we started talking about oil. A lot of oil comes from Texas in America. We were talking about how the weather disruption made the latest gasoline and oil inventories perhaps not comparable to previous years. But again, that goes back to that winter shock that we saw last week. And especially, where did it take place? It took place in Texas. And I have a fascinating article here, Jeff, that I would just want to bring up a few comments here. It's got something to do with collateral. I'm going to read it out. You jump in if you hear anything interesting. And I guess it ties back to our little discussion of anomalies that we talked about in part 1. So let's see here. When did this come out? Wednesday, the 24th, the Financial Times. Power market credit crisis looms as Texas bills come due. The Texas electricity crisis last week has morphed into a credit crisis in the state's wholesale power market, where participants have begun defaulting on a portion of the $50 billion in energy purchases made during the record cold weather, according to an update from the grid operator. The Electricity Reliability Council of Texas, which serves as a central clearinghouse for buyers and sellers in the wholesale electricity market, said on Wednesday that it had tapped emergency funding to cover failed payments. The bill is now coming due as buyers, such as electricity retailers, municipal utilities, and power generators, have to post collateral as a down payment on purchases. Some retailers have failed to deliver. Ken Ogelman, ERCOT's vice president of commercial operations, told the agency's board. Defaults are possible, and some have already happened, he said. If buyers are not able to cover their bills, ERCOT will pay the generator, and the charges will ultimately be spread out to other market participants, including other generators and traders, as permitted by regulations. Collateral requirements soared as a result of the electricity price rise. The total amount held at ERCOT at the start of February totaled about $600 million, but a single company, power producer Exelon, said on Wednesday it had posted $1.4 billion of collateral with ERCOT. It has funded the collateral call with new borrowing. Collateral requirements would peak on Thursday and Friday this week, that's today, and add financial stress on market participants, Ogelman said. It sort of reminds me, doesn't have to be this way, but it sort of reminds me of the 1906 earthquake in San Francisco and how a call went out to insurance companies and across the United States, to New York, to Britain, that said, we need money to rebuild, and we're pulling this money in. And that set off what would eventually be the 1907 financial crisis. But I guess, Jeff, do you have any thoughts? Collateral, tense?
It sounds like an operational error, right? Because essentially ERCOT operates like Fedwire. It's it's not an interbank system, but it's an intersystem a way of settling financial transactions in the energy market. And of course, they're the ultimate arbiter. They're the ultimate settler of all those payments, and they're on the hook. And they're going to try to get paid. And it sounds like they're going to have a lot of trouble getting paid, which only creates, as we talked about in the earlier segment, this kind of informational asymmetry creates uncertainty, not just financial uncertainty, but legitimate uncertainty, legal uncertainty, all sorts of things that cause behavioral changes, risk aversion, things like that, downstream effects that maybe we don't see right now. And you would expect, given the fact that the energy market is scrambling for collateral and trying to figure out who's going to pay what, where, and when, given how just overall repo markets, collateral transformation has, over the last 5 years in particular in the United States, the collateral conditions across the entire repo market have been dictated in some ways by the energy market. I mean, junk bonds, the biggest supplier of junk bonds for the last half decade have been in the energy sector. And we saw that last March. It's, when oil prices collapsed, what happened to junk bond prices? They collapsed too. And that was one of the triggers for the collateral squeeze, the collateral bottleneck, as we said, because energy bonds, energy junk bonds in particular, are closely related to some of the fundamental factors in the repo market. And so we don't really know yet how this would play out. It may be just one of those anomalies that, we look back on and say, yeah, this is the system performing well, but it may also turn out to be a case where we don't really see the hidden aspects that are already starting to work their way. I mean, maybe that's why bill yields have been falling since then, at least over the last little while. It may be that there's a scramble collateral that's starting to really become a major issue, or at least more of a major issue.
Well, yeah, that's right. That's, I guess, what this whole show has been about, is that when do anomalies transform into triggers? When the system is fragile. And there's just been an accumulation of anomalies recently with the so-called SLR cliff, the Fedwire. This situation in Texas could be nothing. Could be
Yeah,
something.
I mean, that's what we're really talking about here. Monetary resilience is a margin for error, right? It's the capacity for the dealers who are at the center of that system to absorb these anomalies. When things go wrong, we need that extra spare capacity to come online. And the energy sector is a perfect example. One of the reasons they had power disruption is because they couldn't have spare capacity. Some of these standby power generation facilities were not allowed to come online and fill in the gap. That was the perfect analogy to what happens in the monetary system. Dealers are supposed to have spare balance sheet capacity that they can tap into when things go wrong. But as we've seen, especially over the last couple of years, going back to September 2019 repo, what we've seen time and again is dealers during these periods where they're risk averse, they either don't have the spare balance sheet capacity to tap into, or they just flat out refuse to do it, which means that the system that should have this ability to absorb shocks suddenly doesn't have any ability, and these shocks become much bigger than they ever had been before. There's always anomalies, there's always going to be crises and little problems and big problems and all these other things. What's missing and what turns them into bigger deals is the fact that we don't have our monetary shock absorber, which, I mean, we're supposed to believe that's the Federal Reserve, but let's face it, going back 13 years, they have performed so poorly at that task that it boggles my mind that anybody still believes that that's the case.
Jeff, I thought this was a great show. I loved it. And if you have any concluding thoughts, let me know. Otherwise, off into the weekend we go, and I'll talk to you again next week.
Okay, Emil, take care.